Hello guys, welcome back. So Cisco Systems is the next victim of this current market situation where everything is down. And right now it's down about 13% on the pre-market. We're expecting it to be, I suppose, around $42 to $41 when the markets open. But this has happened because of the earnings report of the company and the overall market crash for the most part. And as we'll see here, we can take a little bit of a closer look at why Cisco shares have tanked pretty much. You will see that the net income printed was 3.04, which is actually more than the projected, than the last year's 2.86 billion. And the per share earnings of 73 cents are better than 68 cents of the previous year. And you will see here that the revenue remained roughly the same, so roughly flat here. And interesting to notice that the future guidance that the CEO provided here mentions that the revenue could slide by up to 5.5% in the current financial quarter. Also lowered its full year guidance for revenue to a 2% from 2 to 3% versus the expected 6.5 increase it had forecast earlier. Interesting. But of course, as you'll see here, Cisco has dropped quite significantly, about 25% already. And now with this extra decline today, we're probably going to see something roughly around the region of 32-33% or so if this continues. But we do want to examine what the company is doing financially just to see whether it makes sense to buy it now. And there are some very interesting remarks and notes about this company, which I will take you through when we take a look at the financial statements so that we can understand what Cisco is doing. Now the P ratio of the company is at 17 right now. It's going lower, and the price to free cash flow ratio also lower, 30.6. Notice that the company has been buying back shares a lot. 17% is nothing to sneeze at, that's a lot. And so this has a direct effect on the total equity growth, as you'll see here, of course, because it decreases total equity. And it's still a good thing overall. We will examine what that means a little bit later. But the total liabilities to free cash flow over here, you will see that it is 3.81, meaning that the company would require about 3.8 years of its current free cash flow in order to pay back all the total liabilities as recorded in their balance sheet. Now, the total equity growth of the company has been slow, of course. This is a very large company, making about 48 billion in revenue back in 2017. Then it went up a little bit, then down. This will happen with large companies. This is a giant, so you can expect it to grow massively every year. And the net income growth has been growing, which is nice to see. Same with the free cash flow growth, another nice sign here. But again, the total equity is down for a reason, which we will examine a little bit later. We talked about it a little bit already. Now, interesting to notice, return on equity is higher here, but remember that return on equity is what? Is net income divided by the total equity, the total stockholders' equity. And so, as the company is buying back shares, the total equity is going down. Because when we're buying back shares, we're spending cash from the company's reserves. And our total equity goes down because we're now actually removing stock from the public. And so now we have less equity, but we have less shareholders as well. And so this balances itself out. But this also means that because of less total equity, the division between net income and total equity generally yields higher results here. So this is how you can actually use buybacks to affect the return on equity, for example. Interesting to note as well, because the net income is going to stay the same. Now, the margins of the company are not bad at all, as you'll see here. And also, it's paying a almost 3.1 dividend yield for the last 12 months, that's TTM. And it's a payout ratio of 42% in terms of the free cash flow and 52% in terms of the net income. This is more important, of course, and below 50% is fairly nice. Now, I want to take a little bit of a closer look just to see the effective dividend yield right now. It's 3.14. Currently with the current stock price, but remember, when the markets open, the stock price is going to be lower, so this is going to be higher because now the stock price is less. We're yielding more from owning a specific amount of stock, and so you will see also that the dividends have been increasing pretty much every year for the company, very steady increase for Cisco, and no slumps at all. They haven't decreased their revenue in the last at least 10 years or so, 12 years or so. So let's examine a little bit more detail what's going on with the income statements of the company. Now remember, the revenue has been pretty steady here, and the net income from 9.6 to 10.59. But the interesting stuff starts at the balance sheet. And you will see here that the company has been selling their short-term investments quite a lot here, from 58 billion to 15. They sold a lot of these. And with selling these, of course, they generated cash, which they used to buy back shares. Remember, 17.5% or so is what they bought back, which means that they spent a lot of cash. And so their total equity went down because, of course, this cash was spent to buy back shares. Now, this is not a bad thing, because when I explained that earlier, when the total equity decreases and we have a buyback, also the shareholders' pool decreases. We have less shareholders, and so it's normal to have less equity, because now we are using our contra account, as it's called, to get extra treasury stock, which is what we are buying back. This is how it works. And if you take a look at the cash flow statement, you will see that the cash provided by operating activities has been increasing for the company as well, with investing activities cash flow being in the negative over here, because the company has been acquiring stuff and purchasing some investments here, also selling some in the meantime. Very normal stuff. Paying a little bit of a dividend here, of course, and repurchasing common stock. Look at this, 18 billion here, 21 billion is what the company has been using its money to pretty much buy back shares with. Now, the cash at the end of the period, about 10 billion, pretty much steady cash, a little bit less than what the company used to have. Remember, they have been buying shares back like crazy. 12.91 free cash flow billion over here, the first year in 2017, and 14.76 in last year's free cash flow. Pretty nice. Now let's take a look at the stock evaluation tool and see what kind of price it makes shares to pay for the company. And remember, the company has purchased back shares, which means now we have a smaller pool to distribute profits to shareholders. And so this means that it's a good thing that stock was repurchased, but you can understand how this kind of repurchase can affect and will affect the total equity of the stockholders without really unbalancing everything. Everything is still balanced. So in terms of revenue growth, I will go 0 for our low ones, then I will go 0.5 and 1% for our high ones, which I think makes sense. The company is not growing much, but it looks like they could achieve this kind of growth, which is almost negligible here. And you will see, that the company has been in a relatively steady pace, 0.3 in the last 5 years, basically not growing at all. Net income margin over here, you will see that it has been around the same levels minus this year, for the most part near 20. So I will go maybe 19, 20 and 21 here. And for the free cash flow margin, I think I'm gonna go somewhere in like 100, 110 and 120, which seems like the company is doing quite a lot of, about 120 or 130. And annual return of 13% is what I typically wanna make out of my investment, pretty much, because I can get 10% out of an ETF, an S&P 500 ETF. So I hit calculate here, and you'll see that we are still a little bit far from what we'd like to see in terms of the price, the stock price. Yet remember, it's down today, so it's actually going to be at this level, if not less than this level. So this is going to be green when the markets open, because it's down about 12-13% from its current price, which is this one. And so Cisco is arriving at a place where I would be potentially interested. I'd like a little bit more of a decline, mainly because of the revenue growth. I don't think the company is going to be doing that well in terms of revenue growth, at least based on what they have been doing historically. Maybe the next years are going to be better, but based on the historical revenues here, it looks like we should be potentially looking to enter the company near the $30 mark, maybe 35, somewhere around there is where I would be interested about the company, I think. So this is where I would potentially buy. So thank you for watching this one. I hope you enjoyed this video. Let me know what you think about Cisco. Remember to leave a like and subscribe. And thank you for watching this video. I'll see you in the very next one. Bye bye for now. See you later.